Welcome to the second video of Chapter 9. In this video, we will go over the slick 4 razor blade project in detail. Because this is our first case of DCF analysis, even though this is a relatively simple case, I will go over this case in detail. So I prepared a Word document that outlines the details of this project. So when you look at this project, this is a $800 million project. It lasts for 5 years, and $800 million will be spent to mainly buy the machines. And the machines, after the project is over, the machines will be sold for scrap metal for $50 million. And this is what you call as a salvage value. And for that, the firm will pay $10 million tax, right? So these are all the cash flow from investment, right? And we have to consider this. The second part of the question is there is investment in working capital, right? So when the project is initiated, initially the company has to make an investment in the inventories, and that's a $10 million. And in year 1, it accumulates additional inventory, which is $20 million. And in year 5, the company begins the planning for the next generation blade, and it decides to reduce its inventories, so it will phase down this product. So the company will gradually reduce the inventory to 0 in year 5. So when you look at the total working capital in this case is all inventory. Total working capital in year 0 will be $10 million, and it will go up to $30 million in year 1, 2, 3, 4, and in year 5 it'll come down to 0. And I hope you remember that for the purpose of the cash flow, what's important is not the level of the working capital. What's important is the change in the working capital, whether the working capital has increased or decreased. This is because the working capital is a stock variable, right? They show up in the balance sheet. And to turn that into a flow variable, instead of looking at the level of the working capital, we need to focus on the change in the working capital. So that's the reason why we have a separate line here. So investment in working capital is the change in the working capital. So in year 0, the working capital inventory has gone up from 0 to 10, so this is the change. And between year 0 and 1, the inventory goes up from 10 to 30, so the increase in the working capital is at 20. And between year 1 and 2, 2 and 3, 3 and 4, there is no change in the working capital. So the change in the working capital is 0, and because of that, the cash flow from the working capital is also 0. And in year 5, the inventory goes down by 30, right? And the last thing that we have to remember is that increase in the working capital is a cash outflow, right? So whenever there is an increase in the working capital, that's a cash outflow. When there's a decrease in the working capital, that's cash inflow. Please remember that. The last one that we have to consider is the other cash flow from operation. So for that, we have to actually look at the income statement. So this project generates the revenue of $600 million, and the expense is $300 million. And because the company made the initial investment of $800 million, and it's supposed to last for 5 years, assuming a straight line depreciation, the annual depreciation is $160 million per year. So we have to consider all this, right, to think about EBIT, taxable income, and to find out how much tax the company should pay, and what the net income is. And then once we get the net income, right, we have to add back the depreciation to calculate the cash flow from operation. So we have 2 separate parts for the cash flow from operation. One is the net income plus the depreciation. The other is the change in the working capital. And because the change in the working capital is a little bit complicated, we separated the change in the working capital here from the rest of the cash flow from operation. Okay. Then we add the total cash flow from operation to the cash flow from investment to find out the free cash flow. Okay. And once we figure out the free cash flow from the project in each year, right, then we can use that to calculate the net present value or the internal rate of return. Okay. Now, let's move on to the Excel file. Okay. So this is the Excel file of this mock razor blade project. So this is the basic format of the DCF analysis that we are going to do. Okay. So the first, what you will see is a set of parameters here. So we are going to provide a set of parameters like inflation rate, discount rate, the percentage of account receivable as a sales, which we are not going to use here. And in case of the inventory, usually it's a certain percentage of the revenue or the cost. But in this case, because it's a more simple case, the value of the inventory is actually given instead of this. But in more complicated cases, usually inventory is a certain percentage of the revenue or the cost. Then the tax rate is 35%. So these are the parameters that we are supposed to work with to generate the entire table of the cash flows and for a proper net present value and the internal rate of return analysis. Okay. Now, part A. The part A is basically the investment in the fixed asset, right? And as you know, this is basically cash flow from investment. So in year 0, the company purchased the capital asset of $800 million, right? So it's a net purchase. So when you think of a balance sheet, the company's fixed asset will go up by $800 million. But at the same time, if the company actually used the cash to make this purchase, the company's cash holding will decrease by $800 million. So this is the cash outflow, right? And after that, there is no cash flow from investment activities from year 1 to year 5. And when the project is over, here we are assuming that the company sells that machine at the end of year 6. And the question said that the company will sell the machines as a scrap metal for $50 million. And out of that $50 million, $10 million will be paid as a tax. So the net cash inflow, which is the sales of the fixed asset, will be $40 million. So this entire section covers the cash flow from investment activity from year 0 to year 6. Okay. The second section is the working capital section. So this is investment in the working capital. And working capital, as you remember, is current asset minus current liability. Right? So we will pay attention to what happens to the inventory, what happens to the account receivable. So these are current assets, and account payable is the current liability. So we will trace the changes in current asset, current liability, and record the level of these variables in each year. So we know that from the question, the inventory in year 0 is a $10 million. It goes up to $30 million in year 1 and stays at that level till year 4, and in year 5, working capital goes down to 0, right? So this should be 0, not negative 30. So when you look at the level of the inventory, it was 10 in year 0, 30 throughout year 1 to 4, and it becomes 0 in year 5. So when you look at the change in the working capital, in year 1, working capital goes up by 10, and between year 1 and 2, working capital goes up by 20, so it becomes 30. And between year 0 and 1, the change in the working capital is 20. Between year 1 and 2, 2 and 3, 3 and 4, there is no change in the working capital. Between year 4 and 5, because the company will use up the inventory, right, to wind down the product, so the inventory will go down by 30. So this is the change in the working capital. And because the increase in the working capital is a cash outflow, when you look at the cash flow from the investment in the working capital, right? So this basically is the cash flow from the changes in the working capital. So it's the inverse, the negative of the increase in the working capital. So if the working capital goes up by 10 million, that's a cash outflow of $10 million. So initially there is cash outflow because of the build-up of the inventory. And at the end of the project, there's a cash inflow because the company will use up the inventory. Okay. Now, the third item that we have to consider is the revenue the project will generate, right? So according to the question, this project will last for 5 years, and from year 1 to 5, it's going to generate the revenue of $600 million. Okay, and the expected expense is $300 million. And because the company made the investment of $800 million that will last for 5 years, the depreciation is the initial investment over the duration of the project, which is duration of the machine, which is the 5 years, right? So the annual depreciation is $160 million. So when we calculate the pre-tax profit is revenue minus cost minus the depreciation. So this is the pre-tax profit, and we know the tax rate, which is given here. So tax is the tax rate times the pre-tax profit. So the amount of tax is $49 million. Okay. So what is the net income? Net income is the pre-tax profit minus the total amount of tax. So this is the net income. Okay. Now, we already talked about the difference between net income and the cash flow from operation. And for our purposes of calculating the net present value, we need to use the cash flow from operation. So we learned that the first step of the cash flow from operation is to add back the depreciation to the net income. So this was the net income, and add back the depreciation. So this is the expected cash flow from operation in year 1, right? So in year 0, the company will spend $800 million, right? And also the company will spend additional $10 million to build up the inventory, right? And in year 1, the company will generate the cash flow of $251 million from its operation. At the same time, because the company will build up the inventory even more, there is additional cash outflow of $20 million. Okay, so that's the kind of picture that we are looking at, right? Now, the next thing that we have to consider is the overtime change, right? Here, we are assuming that there is no inflation, right? So we are expecting this revenue and cost and all this to continue at the current level, right? But just, make this case a little bit more flexible. Let's make this form ready for any change in the inflation rate. So let's say everything goes up at the rate of inflation. Revenue goes up at the rate of inflation. Expense goes up at the rate of inflation. Then the revenue will be revenue times 1 plus the inflation rate, right? So in this case, I didn't lock the cell because this cell itself has its own name called the inflation. So I don't have to lock the cell because this is the only cell that has the name of inflation. Okay, so the revenue will be revenue in year one, in year two will be $600 times 600 million times 1 plus the inflation rate. Okay, and the cost will be the same. And one thing that you have to remember is that in case of depreciation, you cannot increase the value of the depreciation even when there is inflation. Okay, the government does not really allow it, so the size of the depreciation doesn't change. Okay, whether there is inflation or not. Okay, then the rest is simply this, the pre-tax profit is the difference between revenue minus expense minus the depreciation, right? So I will do all this. So all that I have to do after this is to scroll this thing down, right? And once we set up the year two cash net income and income statement in such a way, we can just scroll this thing down to year 5. Okay, so now we have the cash flow from operation from year 1 to 5. We have cash flow from the investment in working capital in here, and we have cash flow from investment activity here, right? So the free cash flow that we have to use to calculate the cash flow that is generated by an investment project, all that we have to do is to add all three: the cash flow from investment activity, cash flow from the investment in the working capital, and cash flow from the rest of the operation. Okay, so that's what we are doing here. So we are adding this cash flow to this one and to this one, right? So this is the total cash flow generated by an investment project. Okay, so when I scroll this thing down, right, this is the expected total cash flow that will be generated by this investment project. So initially the company will spend $810 million, and then from year 1 to 6, these are the cash flows that will be generated by that investment project. Okay, then we can calculate the discount factor and the present value of each of these. Okay, and we can calculate the net present value, right? Or another way of calculating the net present value, right? If you don't want to calculate the discount factor, or if you don't want to calculate the present value for each case, then we can simply use the net present value function using the cash flow that we identified. So we know that the discount rate, which was given here, the discount rate was 12%, right? So the net present value and the discount rate is here, right? 12%. And we have to highlight all the future cash flows. Right? Then we add back the initial cash outflow. So this is the net present value. Okay. And what is the internal rate of return? We can easily calculate the internal rate of return. And I told you that you should not use the present value to calculate the internal rate of return. Always highlight the future cash flows. Okay. So do not use numbers that you calculated here. Always use the number total cash flow, not the present value of the total cash flow for your internal rate of return function. So you can see that internal rate of return of this project is 17.27%, which is obviously greater than 12% discount rate, and it is consistent with the net present value calculation that this is a good project, it's a profitable project. Okay. One last thing that I wanted to add was MIRR. So this is the modified internal rate of return, and I hope you remember what this is. And in case of MIRR, we can highlight all these values, right? And then for finance rate, we can always use the discount rate, right? Then the next thing that we have to type in is the reinvestment rate, right? So are we assuming that, this $231 million that the company has generated in the first year will be reinvested and earn the same return as the internal rate of return or the discount rate? So if you want to say that discount rate is a more realistic assumption, then we can say this is again the discount rate, right? Then we will have slightly different value. Okay. So if we assume that all these proceeds generated by the project is reinvested at the market rate, then the internal rate of return of this project is 14.49%, which is still greater than the discount rate. Or if the proceeds can be reinvested and earn the same rate of return as the internal rate of return, then the rate of return from this project is 17.27%. Okay, so that's the analysis of the slick blade